Hello friends, and if you've opened your letterbox or your MyGov inbox recently and found something from Centrelink, don't put it aside for later. I want you to actually stop and listen to this one, because that letter is very rarely just a courtesy update. Every year, thousands of age pensioners get a letter that quietly changes how much money lands in their account, and most of them don't realize anything's different until a fortnight goes by and the payment doesn't add up. Sometimes it's good news they never claimed, sometimes it's a correction that if you miss the response window becomes very hard to undo. Here's the part almost nobody tells you. Services Australia doesn't ring you up and walk you through what a letter means. They send the letter, they set a deadline, and if you don't respond or you don't understand what's being asked, they act on the assumption that you agree. That's the whole game today. 5 specific things to check the moment one of these letters lands on your table, so you're the one deciding what happens next, not the department by default. Before we get into it, if you haven't subscribed yet, do it now, because these thresholds move constantly. Deeming rates change this year. Income and asset limits get indexed twice a year in March and September. The rules that applied to your neighbour last year might not be the rules that apply to you now. People who follow this channel find out about these changes while they can still act on them. Everyone else tends to find out 3 months later when the underpayment has already piled up or the deadline's already gone. Hit subscribe, turn the bell on, and let's get into the 5 things. Thing 1. Check exactly what the letter is actually about. This sounds obvious, but it's the single biggest mistake pensioners make. They skim the first paragraph, see the word Centrelink, feel a jolt of anxiety and either panic or ignore it. Neither helps you. Centrelink letters generally fall into one of a few categories, and each one needs a completely different response. A review or reassessment letter. They want updated information about your income, assets, or living arrangements. A rate change notice. Your payment is about to go up or down because of indexation or a change in your circumstances. A request for documents, proof of income, proof of a relationship change, proof of an asset sale. An overpayment or debt letter. They believe you were paid too much and want it back. The heading and the reference number at the top tell you which one it is. Read that first line properly before you do anything else. If it's a review, there will almost always be a response date, and this is where people get into trouble. If you don't respond by that date, Centrelink can suspend or reduce your payment automatically, and getting it reinstated can take weeks of phone calls. Circle that date. Don't rely on memory. Thing 2. Check whether the letter reflects the current thresholds, not last year's. Here's something a lot of pensioners don't realise. The income and asset test limits are not fixed numbers. They move on 20 March in 20 September every year, and in 2026 they've moved again. Right now, a single homeowner can earn up to $226 a fortnight and still get the full pension. Above that, it reduces gradually, cutting out completely for a single person once income passes roughly $2,627 a fortnight. For couples combined, the full pension threshold is $396 a fortnight, phasing out around $4,016 a fortnight combined. If you're working part-time or picking up casual shifts, there's also the work bonus. The first $300 a fortnight you earn from work isn't counted in the income test at all, and unused amounts can build up in a bank of up to $11,800. A lot of pensioners don't use this properly and end up reporting income that should never have been assessed in the first place, which knocks their payment down for no reason. If a letter references an income or asset figure that seems out of step with what you now know the current limits to be, that's worth querying rather than accepting. Assessments do occasionally use outdated figures during the transition between indexation periods, and a phone call to double-check costs you nothing. Thing 3, check your deeming rate, because this one catches people out constantly. If you've got savings, term deposits, shares, or an account-based super pension, Centrelink doesn't ask what interest you're actually earning. It assumes or deems a rate of return and assesses you on that assumed figure, whether your bank account is actually paying that much or not. As of this year, the deeming rate is 1.25% on the first $64,200 of financial assets for a single person, or $106,200 for a couple combined, and 3.25% on anything above that. This matters enormously if you consolidated accounts, cashed in a term deposit, or moved money after selling a property. Say you had $200,000 sitting in the bank after downsizing. Centrelink isn't looking at your actual bank interest, they're deeming a chunk of that as income at those rates, and that deemed income counts towards your pension assessment. If a lever is telling you your rate has changed and you're not sure why, deeming is very often the quiet reason behind it. Ask them directly, what deeming rate and what asset figure have you used for this assessment? You're entitled to that answer, and if the figure they've used is wrong, it's a straightforward fix, but only if you catch it. Thing 5. Check if you've been quietly assessed on the wrong test or the wrong rate entirely. This is the one that costs people real money over years, not just a fortnight. Age pension is worked out under both the income test and the assets test, and whichever one gives you the lower payment is the one that applies. Most pensioners have no idea which test is actually being used on their file, or that their situation could shift from one to the other after a life event, a spouse passing away, an inheritance, selling the family home. Widows and widowers in particular need to check this closely. When a partner passes away, your assessment moves from the couple rate to the single rate, but there's often a temporary bereavement period where different arrangements apply, and if that hasn't been set up correctly, you can be short-changed for months without anyone flagging it. Similarly, if you've recently become single after being assessed as a couple, don't assume Centrelink has automatically applied every benefit of the single rate assessment, including the higher single income-free threshold. Ring and ask them to walk you through exactly how your current payment was calculated, line by line. It's a fair question, and staff can pull that breakdown for you. Thing 5. Check whether the letter affects your concession cards too, not just your pension. Here's something that gets missed constantly. A change to your age pension can have a flow-on effect to your pensioner concession card, and if your payment stops altogether, you might assume you've lost cheaper medicines and bulk billing along with it. Often you haven't, but you do need to check. If your income or assets have pushed you just over the pension cutoff, you're very likely still eligible for the Commonwealth Seniors Health Card instead. In 2026, the income limit for that card sits at roughly $101,105 a year for a single person, or around $161,768 combined for a couple, and there's no assets test attached to it at all. That means someone who owns their house outright and has a healthy super balance can still qualify purely on income, even without a cent of pension. It comes with cheaper PBS medicines and, depending on your state, discounts on power bills, rates and registration. A huge number of self-funded retirees never apply for this because they assume no pension means no concessions. That's not true, and it's sitting there for the asking. If your letter mentions your payment reducing to nil, don't just close the letter and move on. That's exactly the moment to ask what you might now be eligible for instead. So here's your checklist, saved somewhere you'll actually look at it again. 1. Read the letter properly and find the response deadline before anything else. 2. Check the income and asset figures against this year's actual thresholds, not last year's. 3. Ask what deeming rate and asset value they've used, especially if you've recently sold anything or moved money around. 4. Get them to explain exactly how your current rate was calculated, particularly if your relationship status has changed. 5. If your pension has dropped or stopped, check your eligibility for the Commonwealth Seniors Health Card before assuming your concessions are gone. None of this requires a financial advisor or a lawyer. It requires reading the letter properly, knowing the current numbers, and asking Centrelink direct questions instead of accepting the first line you read. The Centrelink Older Australians line is on 132300, and they can walk through any of this with you over the phone. If this helped make sense of a letter sitting on your kitchen table right now, do me a favour and share it with someone else who's on the pension, a parent, a neighbour, someone at bowls who's been putting off opening theirs. And if you want the next update the moment thresholds change again in September, subscribe and keep that bell on. I'll see you in the next one.